Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Mark Marex, Director of Index Research and Development at Nasdaq Investment Intelligence, to discuss Nasdaq 100 performance over a longer time horizon and how it's tied to the history of Nasdaq and some of our most innovative companies. Mark, it's great to see you as always. Welcome back to Trade Talks. And let's start at the very beginning here. Let's get some history with Nasdaq and our indexing capabilities.
Yeah, Jill, thanks for having me. And thanks for the opportunity to talk about this index with a little bit of a different angle. I was looking through some of the recent rankings of not just the ETF universe. We, of course, think of ETFs as mostly being index tracking products, but even the broader fund universe in the US with mutual funds. And it really struck me just how unique the performance track record of the Nasdaq 100 is. We'll get into that in just a second. On this first slide, just to set the stage, right? This is a timeline of Nasdaq as a company, right? Which began in 1971. That's when they launched the electronic stock market. It was the world's first electronic stock market. That was the same year that Intel went public with an IPO on Nasdaq. Really kind of, I think, ushering in the era of what we consider to be large cap technology companies. Gained traction throughout the 70s and 80s. You had companies like Apple and Microsoft going public throughout that time frame. The Nasdaq 100 index itself was launched in 1985. And then you can see the timeline here: Cisco, Amazon, NVIDIA in the 90s, sort of that first internet.com wave, and then post.com bubble, Google, Tesla, Facebook, right? These are all the biggest names in the Nasdaq 100, the top 7 or 8 names, at least from that sort of tech sphere. And it's really coincided with the exchange becoming the home of not just, I would say, tech IPOs in the US, but IPOs of any major, new, large, innovative company, whether it's classic tech or whether it's innovation driven in a related sector. And that aligns with the fact that since 2014, Nasdaq has been the leader 38 consecutive quarters now for IPOs in the US. And so I think it's very important for people to understand, again, Nasdaq 100 as an index is very unique because it is so tied to an exchange, not tied to a strategy, not tied to a sector, not tied to a country, but tied to this exchange.
Let's break it down even further, Mark. What exactly is the Nasdaq 100?
Yeah, so a lot of people, when they hear Nasdaq 100, they're used to thinking that it's a tech index, that it's tech only, that it's probably, US only. So here's a few kind of myths that I'll quickly dispel. Tech exposure, only about 57% if you go by traditional ICB industry sector classifications. It's even lower than that if you go by the S&P GICS system. It's around 50%. So it's not a pure tech index. It does have major sector exposures to things like consumer and healthcare. It is also not purely a US index. It's 100 of the largest domestic and international non-financial companies listed on NASDAQ. So that means you can be based outside of the US and you can be a company like, AstraZeneca, that is a UK company that has a secondary listing on NASDAQ. You could have a primary listing on NASDAQ, even though you're based in a different country. Companies like Atlassian or Lululemon, right? So it gives you more than just tech exposure, more than just US exposure. And then importantly, also, it's not a pure growth index. A lot of people think of it as large cap growth. That's certainly the appropriate bucketing for it because it tends to be way more exposed to growth than value if you go by those kind of traditional style boxes that folks like Morningstar use. It's usually around twice as much exposure to growth as value, but it does have that diversity, right? It's not pure tech, it's tech plus. It's not pure growth, it's growth plus. And most importantly, right, it's 100% weighted towards NASDAQ listed companies. And that means that by definition, with the exception of a few, listing switches from NYSE to NASDAQ over the past couple of decades, you are disproportionately allocating to companies that have just not been around that long versus sort of the broad universe of US and global stocks. So at a recent snapshot, 86% of the index weighting was allocated to companies that have only publicly listed since 1980. That's just a very, very natural kind of screening process by using the Nasdaq listed only criterion to get you exposure to those innovative newer companies in the newer sectors.
Well, Mark, let's talk about the longer term performance here. And I think the chart really speaks for itself.
Yeah, I mean, this is one of my favorite charts to look at, again, because people think of it as large cap growth, but when you actually stack up the performance, and this is going back to year end 2007, so 15 and a half years now of performance, versus the blue and the green, which are respectively the S&P 500 growth and the Russell 1000 growth, pretty much the top two US large cap growth benchmarks that we have. It's a very, very sizable difference. You're talking around 300 percentage points of incremental performance on a total return basis. The NDX up 750% versus 412 and 463 for the other two. That is way more than doubling what the regular old S&P is delivering at 315. And it is close to the S&P tech sector. If you look at just the tech companies in the S&P, that one's just about the same return. But again, think about the diversification. You're talking only 50 to 60% tech exposure for NDX, but it's giving you the same performance as tech, which is the single best performing sector. So really, really a unique combination of diversification, industry leading returns, and similar types of volatility and risk metrics when we compare it with something that is as diversified and broad-based as the S&P 500.
And finally, let's take a look at annualized returns.
So yeah, so I'll end on this note. I alluded to it. You know, we were looking at the rankings in Morningstar of the entire fund universe in the US. These are actively managed mutual funds, plus some passive mutual funds, plus all the ETFs in the Morningstar universe. So when you break it down and you look at, you know, there's things like multiple share classes with the same strategy. If you pick just the unique strategies that are in the Morningstar universe that have 15-year long track records, and you rank the performance of those funds, there's 937 of them. The QQQ, which is the big Invesco ETF that tracks the Nasdaq 100, is the second best performing fund in the entire universe over the past 15 years, 10-year window. It is the third best performing on a trailing 5-year window. And these windows get bigger and bigger the shorter the time frame goes on, because it's, you know, you get rid of the survivorship bias. But it's just incredible to me that with a passive strategy against all of these active managers over 5 or 10 or 15 years, this is pretty much the top. This is as good as you can do from a returns perspective as an investor with just over 16% annualized in that ETF product. So again, a lot of different ways to think about performance for the Nasdaq 100. This is the way we wanted to present it this time, because we're coming off some pretty impressive rankings, no matter what time frame you use recently.
All right. Excellent insight, Mark. Appreciate it as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.